Good afternoon. Welcome to the TheoTRADE afternoon video. I'm Blake Young. Today is August 21st, 2025, and we're going to talk about Purchasing Managers Index, both services and manufacturing here momentarily, and we'll look at the industries, the sectors, and the broad market and how this may be an impact or an indication of what we may see happening next. And to begin with, we'll just note that the S&P 500 has been trading in this long-term channel, and when it breaks free, it has a tendency to duplicate. So we're kind of on the cusp. Either we're going to bounce and go from 635 and retest the highs, or we're going to break free and pull back, I'm going to guess right around 620. But we want to look at the industrials and basic materials to see, is this report today good enough to push this to the next level? So we're looking there, the flash manufacturing PMI and the flash services PMI. PMI is Purchasing Managers Index. And you can see the data in there as far as what it's looking at. We look at anything above 50 as expansion, growth, demand. Anything less than 50, economic contraction, that we have low demand and we're not expecting to see a growing, robust economy. So this is the earliest indication because we're saying the manufacturing, the factories that are theoretically meeting demand as early as possible in the system, are they buying stuff or not? Well, this 53 outperforming last month and doing quite well, and services, the service side of things, also doing the same thing, have greatly improved. Now, if we look at those numbers, these are rising. And normally we'd have a graph that shows you the ups and downs of every single month, but it's not showing right now. And so we're seeing that it is rising and pushing back above 50. This is a sign of growth, sign of expansion. And if we dig into it a little closer, you're going to see down here, it's kind of hard to see on this chart, but what we saw is manufacturing price input prices, meaning the stuff that they're having to pay is also on the rise faster than the output prices. So we have inflation on the input prices. They're eating and absorbing some of that data. So this goes back to the idea of PPI, usually is an early indicator of CPI, but they're absorbing some of that. So their output prices are rising slower than their input prices. That means they're not passing it all on to consumers. And if we look down here at the lows, we can see the consumer price index is still rising slower as we look at output prices here. So that's quite the significant spike, but it's not being eaten up by consumers totally. It's being eaten up by both producers and consumers. That can only be sustained so long, but it's a good indication that we have growth and inflation. But the question is inflation higher, hotter than the growth? Because that can be stagflation. If we're seeing growth and inflation that's sustainable, this could be a great time to see the turn of the market. We don't know yet. So if we look at that data and dig a little bit deeper into the individual sectors and into the individual stocks, we should expect to see industrials stabilize, if not go up, and we should expect basic materials, because that's where they're buying their stuff, to go up as well. So let's take a look at XLI as a representation of industrials, and let's take a look at XLB. So XLI is kind of holding here at the top. It really didn't get the lift that I would have expected if it's all about factory orders going up and manufacturing climbing and those types of things. I would have expected industrials to turn the corner and break out and keep on climbing. Really didn't see that. But if we know that their prices have gone up and they're taking a shot, they're taking a hit, they're not passing the prices on, then this should come as no surprise that basic materials are up, but industrials are down. They're giving away their margins. If we're going to trade factory, if we're going to trade industrials, we've got to be very selective in finding those that have less elasticity of demand, meaning not a lot of substitution. We want to find those that are not giving up their margins. We want to find the basic materials that are feeding them and trade those if we're going to see this growth continue. So if we go into the market watch, just to quickly scan to see who's done well, we have the S&P 500, all the different sectors here. We're going to click into industrials, and we can see aerospace did well today. And really we have workforce, that's the services side, Dayforce, and that's professional services. And we have construction, Quanta, PWR, and C.H. Robinson that have done well as far as construction. And the rest have kind of been muted green, slightly up, GE Verona specifically, Uber, almost all aerospace. We really didn't get a lot of lift. So the aerospace defense is what rallied. I'm not seeing that as a great sign for industrials and factories. If we look at basic materials, knowing that, again, they're buying materials from here, you can see metals and mining are king. And we even still have CF Industries, and we have Mosaic and FMC. So we're getting agricultural demand, we're getting mining demand. These all did pretty well. I'm not too worried about Sherwin-Williams and chemicals, but it seems like the metals, miners, and agricultural suppliers of basic materials did well today. And so I want to keep looking at those miners. I want to look at packaging. If they're placing orders or receiving orders and making new things, if manufacturing is growing, those things have to be packaged and shipped. So these are all stocks that I'd be interested in looking at inside of metals and mining, agricultural specific like Mosaic, and the packaging and containers. Let's take a closer look. Starting with Newmont. Newmont bounced, broke out, put a new 52-week high in today. We talked about this. I talked about it. Garrett talked about it. The metals and miners are a great place to be because even if gold prices don't continue to go higher, you don't need them to go higher. Gold is almost flat today at 0.11%. And so they don't need to go higher, but the industry, the mining industry, have their highest margins or near their highest margins. So they've got the highest margins. And if the orders are picking up, and they already have their highest margins, this looks very promising for the future. So Newmont, Freeport-McMoRan, and we'll put an FCX here. We're looking for opportunities inside of these stocks. Now, Freeport's not going to 52-week high, but this consolidation that it had, this downward trend line, is being threatened. And if we break free, I expect to see Freeport go back up to 46, if not 48, and we could be dealing with about a 15 to 20% increase in price on Freeport. Newmont, again, 52-week high, so we'd look for that to repeat its last pattern. Looking at the packaging companies like Smurfit, a nice bounce today. I would like to see it break free from this lower highs, lower lows, and clear its 20-day moving average. But if it breaks 44, again, 49 is on my target for Smurfit, and we're looking at another 10% increase. Let's take a look at PKG. Breaking out of its pattern, closing above the previous closes. It hasn't cleared the high shadow, but that high shadow is put in around earnings. So this is the highest close it's had going all the way back into March. I like this breakout, and the volume is huge, all off the expectation that manufacturing is doing well. This could give you an opportunity to buy in closer to 207, and I'd be looking for it to not only get back up to this area, 220, but I'm expecting it to continue to climb if manufacturing continues to do well, and I'm looking for 240. 240 is on my target, and I'm looking for an additional 15% climb in PKG. Now, International Paper, or IP, is holding up its support. And the only reason why I'd still consider this one, where the volume wasn't very high on this bounce, it's not like the others, it just had a very good day, had a 2% day. It's reasonably priced. And what I like about this is if this is going to put in a base, and even though the implied volatility isn't where I normally want it as a percentile, it's still willing to offer me about 3% if I sell the at the money closest to the current price, 48, 3.11% for a month. If I'm willing to own it, they're giving me a $1.50 safety net. And so if I get a $1.50 safety net, it could erase all of today and that again halfway, and I'm still in the trade below support. The price is still below support. If it does get assigned, and I own it at 48, great. I got paid $1.50. My cost basis is $46.50, and I'm looking for it to go from $46.50 as my cost basis up to the gap over here at 53 and probably to 56. So if I own it at 46, I'm going for 56. Now I'm talking about a 20% return that starts with a 3.5% return for a 30-day time period. May not look like much, but the opportunity is pretty solid with minimal risk on IP. I did talk about Altria a couple of weeks ago. New high yesterday, paused today. I would still look for this to pull back more. But while I'm waiting for Altria to pull back, I take a look at CF. And CF is going to give you a higher opportunity as we're attempting to and tried to put a shadow through this high. If we close up today, which we're very close to doing so, if we close up, not only do I think we're going back to the test 90, but I think we're probably going to 100. So we could go from 86 to 100, and we're talking about a 20% return in CF as well. So there's lots of opportunity in basic materials, 10, 15%, 20% on some of these. And if the data that we're seeing in Purchasing Managers Index is correct, that it's the beginning of the trend back above 50 and some growth specifically to the metals miners and agricultural basic material suppliers, then there's your real opportunities. Sooner or later, if that's the case, we will start seeing the margins come back up. But right now, factories and industrials are giving up their margins rather than raising it with the rising prices. So we have inflation, we have growth, we have demand, but they're eating some of those costs, so the consumers aren't getting all of it, which is good for the consumer, but bad for industrials. So let's keep focusing on basic materials and watching for those to continue to climb until we see the margins come back for industrials and factories. That's going to do it for me today. Join me tomorrow as we look at some other long-term trades, and certainly in the morning for all of you that are in the 10% club, and we'll look forward to seeing you then. Have a good night.